Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm your Aldadia. We have with us Chakri, Lokapriya, MD and CIO at TCG Asset Management joining in. Welcome to the show, Chakri. Pleasure to have you and really good to speak to you as well, almost after a year now. Hope you're keeping safe and your team and family is keeping safe as well.
Good morning, Guru. Thank you so much for having me on the show. Yes, it's wonderful to be talking with you. And lockdown especially has created the need for having such shows. And I'm glad that you are pioneering such shows.
Thank you. Chakri, to start off with, I think one blessing in disguise that COVID has actually given out is to all the investors in the markets because from March lows, the kind of rally that we've seen, yes, it has been with minute corrections, but we've seen record high levels. What do you make of this kind of a rally in spite of COVID hitting us?
Yes, hope is a wonderful thing. And that is one of the key endeavors of human beings. And I think it's no different from any crisis. And from an economic perspective and a stock market perspective, that is an important fact. Now, if you, because whenever an economy goes through a major shock, like what's happened because of COVID, then companies and consumers start behaving slightly differently. And some of those behaviors kind of become permanent. So you have a consumer, you have corporate, and then you have the government too, which steps in and comes up with policies which otherwise it wouldn't have had, if let's say there was no COVID. Now, so in this environment, what happens, markets being forward looking, they start anticipating some changes and some companies start benefiting sooner. For example, IT and pharma immediately were beneficiaries, whereas some other companies will lag behind. So for that to play out, usually such crises provide one market returns. And, 3 months, 6 months, 12 months, 18 months out into the future has provided really strong market returns, not just in India, but across the globe.
Right. So, overall, when you talk of this rally as well, do you think this is something which is sustainable, especially if you have to take valuations into consideration as well? Because right now is, the data that you've been providing that we've seen an uptick of almost around 71% from March lows. And the picture that we see of the previous financial crisis as well, we have seen a good rally. So is this one sustainable right now?
This rally is absolutely sustainable, and I think we are still in the very early legs.
Right. And
What's pandemic? Yes.
yeah, go on.
And what this pandemic has done to valuations, and as any other crisis, if you look at the last many crises, long-term crisis, 9/11, etc. So at that point, there is in the market a confusion in the corporates and about how to respond to that. And therefore, the first reaction would be to cut slash profit estimates. And as that happens, the market crashes. And we saw that happening in March and April. And then second is that uncertainty, how fast, how quickly will this problem recover? And during that period, still you will have earnings downgrades and pessimistic outlooks, further market crashes. But then as market stabilizes, the thought stabilizes, then you start looking at normalizing earnings. And in this case, when you discount out into the future, at that point, all that you're moving is you're moving out the terminal value by a couple of years. Yes, 2020 is a lost year. 2021 will be a recovery year. Therefore, the earnings will be weak. On a multiple basis, the earnings will look high, the multiples will look high, the valuations will look high. But on a DCF basis, because if you push it out instead of 10 years or 15 years, you make it 12 years and 17 years, then valuations from an Indian perspective and a global perspective are looking very strong. Given that, there's another important factor, two important factors. One, as we go into 21 and 22, you will see earnings upgrades. So optically valuations will start looking cheaper. And second, interest rates in India and worldwide have come down and will stay low for a period of time. So lower discount rates also supports higher valuations.
Right. So if you're talking of these valuations, Chakri, what's happening is, I mean, people are thinking, have we missed the bus already seeing these record high levels? Because we don't see anything really happening on ground. Macro data is indicating that India is lagging behind in terms of an economic recovery. In fact, if you talk about the RBI monetary policy highlights today as well, they've left the rates unchanged at 4%. They've continued to maintain that accommodative stance. However, they've said that the inflation is expected to remain elevated and the outlook on that front has turned adverse. Economy is recovering faster than earlier anticipated, and they're expecting and forecasting the FY21 GDP at minus 7.5% versus a 9.5% negative what they were looking at earlier. Now, taking these factors into consideration, do you think there is a disconnect between what the economy is doing and what the markets are doing? And what could we make out of this disconnect?
Those are all wonderful questions. So I'll try and answer them. And I think Shaktikanta Das is doing a phenomenal job, right man for the right job at the right time. Any other governor, it would have been a different picture. Now, in terms of economy in itself and markets, we have done some studies, and if you look back at over time, India and other markets, usually the stock markets and financial markets are well ahead of a GDP print and therefore the economic numbers. And actually there is very little correlation. When GDPs slow down or turn negative, the markets can turn up and vice versa because you're anticipating what's going to come next. So from that perspective, if you go back even to pre-COVID times, India was rather just at the beginning of an upgrade cycle. It was not a strong economy. And then what COVID did, it pushed it down. And so you had a negative print of minus 23% GDP number. And then there was the expectations, therefore, some growth will come back, but it'll be minus 9.5. But as Shaktikanta Das today pointed out, that the economy is accelerating better than expected. So instead of minus 9.5, now he's saying minus 7.5. And so some sectors, clearly the recovery is uneven. Some sectors, pharma, IT, the export related sectors, chemicals, all these things will rebound much faster than, let's say, infrastructure or financials. So, and that is a good thing. And that is where the earnings upgrades will come. And that is what will support. So, by the time economic data catches up, which is a good 2 years away, I think meanwhile, the markets will move up fairly significantly. And past crises have shown the markets have moved up anywhere between 80 to some 380% over the following 12 to 18 months from the crisis. So which means we're looking at a very good growth period ahead of us over the next 12 to 18 months.
Right. And taking this growth into consideration, Chakri, especially with global markets as well, one thing that I pick up is that there is enough liquidity in the system, and that's something which is actually moving markets as well. Because if we see the FI data, it's the FI flows into the country are more into the equity side of the system versus debt. Now, do you think this trend is expected to continue with regards FI money as well?
I think the FI will continue to be strong because they always, and I've been an FI manager myself, and so because the growth comes, the earning rather you chase growth rather than value, and you chase because those are the times when it will also do good things to the rupee, because for an FII both or an FPI, it's both real return from the stock as well as the currency movement. So during times of currency appreciation, combined with earning stock returns, it amplifies the returns for an FPI. Having said, so that is point one. Point number two is corporate bond yields. In some cases, is actually more or less in line with equity yields. Now, equity yields provide a higher kicker, and therefore, it makes the greater case for equities, especially given that, fundamentally, we've had, India has had, and the world has had such a big hit because of COVID. So, and the cost of money has gone down because of interest rates moving so low in India and worldwide. So the case for equity becomes stronger and will continue to become stronger over the next 12 to 18 months.
Right. So from here on, what are the key events according to you that we should be watching out for in order to track this kind of an up move?
Okay, so I think that's a very interesting question because what has happened because of COVID is something which has never happened before, at least in the last 100 odd years. So here you are, you're having 200 countries which are suffering from the same disease which they did not, from a corona which they did not see coming. So simultaneously, the whole world went into lockdown, more or less. And so which means you had a very unique situation where both supply and demand froze at the same time. Usually you have a situation where inflation, either there's a supply shock or a demand shock. Now, the reason to understand this better is, let's say that if you want to go during the lockdown to a restaurant, there was the demand for you to go to the restaurant. On the other hand, there was a supply from the restaurant owner to open it for you, but both were prevented because the government had imposed a lockdown. So when this lockdown is lifted, as it's being lifted progressively in India and worldwide, the demand comes back and supply comes back very fast. And during that period, still supply is not evened out, demand is not evened out. This will take several quarters. So then three things are important. So one, we will continue to see positive news flow of demand stabilizing, supply stabilizing. Second, both the big countries, Europe, EU, and the US, really big stimulus packages. US is on the verge of another close to $1 trillion package. And so that will provide an additional tailwind to the market. And third, you will have a synchronized return for the return to normalcy in 200 countries worldwide. And also given that now that the vaccine, the most important news, is around the corner. Yes, it might take a couple of years for everybody to be administered, but there is light at the end of the tunnel. And therefore, these three catalysts will take the markets up.
Right. So if we see this up move, as you're saying, what are the kind of levels we should be looking at on Nifty and Bank Nifty? What are the tops and any corrections that could be in sight whilst reaching that journey?
See, I think between now and the next top, interim top, there are bound to be some in-between corrections. And I think those corrections are opportunities for investors remained on the sidelines to join in. And I would also say that, it's not a time for investors to remain on the sidelines, even at the current levels. They should join in. And because, earnings are going to see a very big earnings upgrade. Now, if you earnings for the US, imagine the largest economy in the world, is going to grow something like 25%, 20 to 25% in the following 12 to 18 months. So you can imagine the growth that an emerging economy like India will have. So against that backdrop, I think, there is a lot of growth out there.
Right. And then to capture this growth as well, what's happening right now is the consumer confidence is really at its lowest in India. If the consumer needs to step up, what are the sectors that could be affected because of this? Because clearly, if you see on the FMCG side, we've not really seen consumption being affected that badly. Supplies have been strong, demand has been strong. On the back of the festive season, again, you have automobiles, consumer durables as well, which has seen good demand. In fact, consumer durables has been on the top since the lockdown. Uh, any of these sectors which you think should be a complete avoid right now?
Uh, I think one is earnings, and one, let's talk about the consumer first, as you spoke about, alluded to, which is basically in the case of the consumer, both in India and outside India, various levels of lockdown, they have largely been locked down, arrested at home. Therefore, their ability to spend on non-discretionary, on discretionary items has been very limited. On FMCG, as you rightly pointed out, you sat at home, you ordered online, you ordered some from your local grocery. But as the second lockdown came, then you discovered that a person is better off. Oh, I need a washing machine, I need a dishwasher. So that stages of growth is still not played out fully. So that leg of adjustments is happening. And three, bigger ticket items. If one wanted to buy a bike or a car for the last 9 months, just could not do so, that was lockdown. So one, there is a pent-up demand. Second, now there is a need to have your own personal mobility. So those will not just autos, but auto ancillaries, a whole bunch of sectors will move with that. And three, many other sectors of consumer durables, for example, airlines, hotels, these are all still not normalized. They're far from normalized. Still capacity at hotels is less than 20 right now. So which means that leg of growth is in its very early stage, and it will still take a long, long time to come. And therefore, meanwhile, you'll have earnings upgrades. Therefore, stock prices will move up. And in terms of what sectors I would completely avoid, I think it is still the power utilities, because until they are government related, and also in terms of still no clarity and power purchase agreement pricing. But outside of that, I'd be by.
Right. And then, Chakri, what would you make of IT, pharma, and chemicals? Because these were sectors which were the first ones to start the rally. Do you think now there could be some bit of cooling off, and this is the time to now book profits in any of these sectors?
Uh, yeah, let's take them one by one. In the case of IT, it brought about a number of changes to the industry, positive changes. One, it accelerated a digital adoption both by corporates and by governments around the world, and that leads to greater, revenue streams for the Indian IT companies. And second is in terms of, they've discovered that, they can actually put 60-70% of their workforce at home and work from home and cut down a lot of costs, which are actually sustainable in the future, which is also margin accretive. Third is, there is a good amount of earnings visibility, because a lot of sectors, just about every sector out there, wants to become IT enabled. You wants to have a digital presence, wants to have greater ERP services. So against that backdrop, greater cloud connectivity. So which means there's going to be good earnings visibility, and Indian IT companies will continue to make that 15%, whether Infosys, TCS, HCLT, as well as the mid-cap IT companies, will make that 15% plus CAGR return for the next few years. Now, pharma, second sector, direct beneficiary of COVID. In addition to the fact that healthcare is a very stable industry, and in addition to that, now there are 7 billion people living around the world, everybody needs to be vaccinated, and there are a whole host of companies. It's not just one. To make the vaccine, you need a syringe, you need injectables, you need APIs, you need chemicals which make the vaccine. So all these very API manufacturers in India, companies like Dr. Reddy, who are tied up with foreign players, with Sputnik. So this tailwind you will see for the next 2 or 3 years as it is administered. And the third is chemicals. Chemicals again benefit from the same reason, and also from the fact that people are moving, broad basing their supply chains because of the lockdown and because of the over dependence on China. They would rather have supply chains in other countries as well. If you take SRF, one of the leaders in chemical industry, they've just announced that they will further increase capacities. It is a company running at close to full capacity, so which shows you the demand, and therefore the revenues will grow very fast. I think that sector will also grow, return 15% plus over 2-3 years.
Right. And with this, what do you make, Chakri, of the financials and the banking space? Because what's happened is we were already talking of a bad bank where we had to resolve the NPA issue. We had COVID, which hit us. And then the RBI has done, okay, you can give out moratoriums, you can restructure loans as well. Now, taking these financial institutions into consideration, the credit growth still has not been that strong, which probably the lending has been really strict right now. With this, the deposit growth has been going up the roof. Do you think, if not now, say 12, 18 months down the line, we could see a major asset quality crisis with financial institutions?
That's a very good question. And financial services is the engine, the backbone of any economy, because they provide credit to the consumer, corporate, and credit to the government. Now, all the three have been hit because of COVID, and all the banking as a sector had NPAs even before COVID. We were restructuring. RBI was trying to do its best to fix the problem. Bad bank is a good thing, but unlikely to happen in the near future in this country because of the political crosswinds that you have. But the one good thing which has happened because of RBI is a number of banks have increased their provisions, they've strengthened their balance sheets, raising their capitals. Yes, government did this little bit in merging together various PSU banks, therefore evening out the capital requirement. So what COVID has done uh, incrementally to NPAs is, once the Supreme Court actually finalizes itself, the judiciary finalizes itself, it'll actually put an end to this crisis, because I think what the market is peak provisioning. Now, the good news is, because we know that a vaccine is in sight, then it allows banks to peak provision their losses. So the NPAs this time around are unlikely to be higher of the last NPAs. NPAs have not really come down. You look at PSU banks, still NPAs are very high. And but I think so, but the valuations have corrected very, very significantly, both for NBFCs, for PSU banks, and private banks. So which means that correction has happened in terms of valuation. So there is no downside to the stocks, taking into account where the NPS currently are and will be for the next couple of years.
Right. And then with this, if you have to talk about an HDFC bank right now, that's a bank which has been insulated. And now you have the RBI, which has come ahead and halted HDFC from issuing new credit cards. Do you think it poses any concerns to you as an investor?
Absolutely no concerns. I think this is just a transitory thing. And they're doing a great job, HDFC Bank, digitally. And I think they're at the forefront of the digital banking. And yes, RBI also has been prudent in highlighting the fact, also the fact that India focuses a lot on the end consumer versus unlike other markets. That perspective, yes, there will be a certain amount of strengthening of the systems, which anyway an HDFC bank would do. But I think they're so far ahead in their digital infrastructure uh, ahead of other banks, that is.
Mm.
So they will take market share. And I think the bank is well positioned and it will continue to deliver its CAGR that it's been delivering over the last several years.
So, Chakri, between an HDFC, Kotak, Axis, do you think HDFC Bank still remains a top pick?
Fortunately for itself, has remained rather trouble-free. Its NPS never spiked,
Mm.
capital was always in excess. There was a very smooth transition to the new management. Uh, Everything about it is well in place, well-oiled machine, and good balance of books. So I think it's a well-discovered stock. Clearly, the digital is a new bit of it, which will add to the incrementally to its growth. I see a steady return up from here, from this point onwards.
Right. And apart from the private banks, what do you make of the PSU banking space? Because clearly we are seeing, we've already seen some bit of consolidation that has already happened within the PSU space. And now, from here on, do you think privatization is something that needs to be considered? Consolidation is something that needs to be considered. And, you have the RBI has come out and said that probably industries can also come ahead and apply for a banking license. So, between the space, any picks that you would have, especially from the PSU space?
Okay, in the PSU space, I think privatization is a good thing, but probably good some time off. It's unlikely to happen anytime in the near future. Whereas RBI is allowing industries to come in is a good thing because India is still an underbanked nation. Cost of funds as well as penetration needs to go up. So while some might have some concern about industrials getting into financing and therefore it might not the loan allocations might not be that great. I don't buy the theory because worldwide you have had, and there'll always be good guys and bad guys. So it's your job as a fund manager to distinguish between them. And then if you look at PSU banks in itself, for example, Canara Bank, it's raising a QIP of 2,000 odd crores in this week or so. The bank is trading at about 3 times book value. Now its NPAs are at 10 odd percent. After this capital raise, provisioning will grow up, will increase the growth capital. It provides the company's growth capital for the next couple of years. So, and this is the story that you will increasingly see in PSU banks. Now, 0.3 times for one of the largest banks in this country is an exceedingly cheap valuation, because what the market is thinking is, 70% of its loans are going to go bad. Now, that is unlikely to happen. So as that confidence comes back in terms of seeing a successful QIP, a successful capital raise, you will see a re-rating of the valuations of PSU banks. Still is a hugely undervalued bank. Will do phenomenally well in terms of returns over the next 1 year or so.
Right. And from the FMCG space as well, Chakri, clearly you've seen good growth, good volume growth coming in. ITC has been under scrutiny by investors over the last couple of months. What would you make of an ITC from here on? And from the FMCG pack, we've usually seen that valuations have always been expensive. What would your top picks be?
Yes, valuations in IT space, in the FMCG space are, they can support, they deliver also very high ROEs. When you have a levered having an ROE excess of 100%, then it can support a 60, 70 times multiple. Now, so in that space, several, for example, in this lockdown, companies, much smaller companies like Marico, Emami, all these companies, Britannia, all these companies are now branching into new territories. Emami is now also going to make various health-related products. People newfound love for health because of COVID and the reason to stay more healthy. So that will provide a tailwind to the company. That company will, I think, valuation is still looking good, and I think stock market returns are still fairly strong for the company. ITC, the well-run company, its cigarette business is a cash cow. Using that business to fund the growth of its FMCG and its other businesses, the hotels, and the hurt it fairly badly. And second, there's always some amount of concern of what will happen because of the Suti sale overhang, which is a big one. And of course, will there be additional taxes on what is considered a sin business of the cigarette business, as the government likes to put it. I think those are the reasons why ITC has underperformed, and I don't see a clear trigger other than valuation for ITC. So I would continue to stay away from ITC.
Right. And the latest one coming on the consumer side right now is a Burger King. Valuations looking really attractive versus listed players. It's got a good participation from retail investors as well because of, yeah, I mean, the book has been small for the retail side of participants. What would your view be on a Burger King?
You hit the nail on the head. The book is overall book itself is a small fundraising for a very good, well-known global leader. Burger King is known around the world, late entrant into India, but still as a space, there's a huge growth curve ahead of Burger King in India in terms of store expansion, and also they're cutting down debt from from the IPO that they're going to do. And it's priced far more attractive than the other companies like Jubilant, similar companies in this space. So I think this offering will do very, very well. And clearly, it's an offering worth subscribing because not only its valuation currently is attractive, I think has very strong growth prospects in terms of penetrations across India.
Right. And Chakri, if someone is not, I mean, is not allotted anything at IPO level, do you think 80, 85, 90 rupee price band would still be a good entry point for participants?
I think so. I think the IPO band that both the ends of the band is attractive, and I think the company will do well post listing, and I think there's a significant growth of. And also, mind you, the company is now going public at a time when people are lockdowns are ending, and therefore its same-store sales growth will actually see earnings upsides because as people gain confidence, they start going out more, and so Burger King will see a greater than expected revenue and that is always a good thing for stock valuations. So I think that Burger King as both as an IPO and after that is worth buying.
Right. And very largely, Chakri, overall, we are expecting an uptrend to continue from here on, taking the current market scenario into consideration. What would be those 3 to 4 stock picks that you would recommend or you would want to buy from here on or start accumulating to make the most of it?
Okay, there are so many good stocks. In fact, both in I think 2020-21 is going to be a very, very good year, and the rally is beginning to get broad-based. There is a lot of opportunity both in consumer, companies like Crompton Consumer, among banks, Federal Bank. It is trading at 0.6 times book value. Like Jindal Steel and Power, the stock has done very well, but will continue to do well. So it kind of gives you an insight into our thinking where we think consumer, metals, cement, all these consumer discretionary, which is autos and tire companies like JK Tire, Apollo Tires, all these cyclical spaces will come back very strong. When I mean come back, you will see an increased earnings uptick. And this is what Minister keeps talking about, a V-shaped recovery. And I think we're probably still not there. So I think 2021 is going to be a really strong year.
Absolutely. So 21, hoping for a strong roar from here on. And I think for all investors who think they've missed the bus, as per what Chakri is saying as well, I think you could still look at entering the markets from here on, because the journey seems to be long and good still for the equity markets. Thank you, Chakri, so much for joining us on the show. It was a pleasure to speak to you. And it's really great to speak to people who are really optimistic and positive as well. And the views are correct going ahead, because there is so much pessimism in the system. There is so much of scare in the system right now that people are really finding it really difficult to take a plunge in the equity markets once again right now, though we are at record high levels. But thank you so much. Pleasure speaking to you. I hope you enjoyed the conversation as well. Stay safe and speak to you soon again.
Thank you.
Thank you.